If you had $100,000 to invest today, would you rather own America's biggest growth companies? Or get paid thousands of dollars in dividends every year? Because that's essentially the decision investors face when comparing SCHD and VOO in 2026. And while both ETFs have delivered impressive results over time, they were built for very different purposes. In this video, we're breaking down SCHD versus VOO. We'll compare performance, dividend income, growth potential, risk, and which ETF may make more sense depending on your investing goals. Because choosing the right ETF isn't just about chasing returns. It's about finding an investment strategy you can stick with for years. Welcome back to Asset Index. Let's get into it. First, let's start with SCHD. SCHD stands for the Schwab US Dividend Equity ETF. Its primary goal is to provide investors with a combination of dividend income and long-term growth. The fund focuses on roughly 100 high-quality U.S. companies that have a history of paying consistent dividends. But SCHD doesn't simply chase the highest yields. Instead, it screens companies based on factors like cash flow, dividend sustainability, financial strength, and return on equity. This means SCHD tends to hold mature, profitable businesses. Companies like Coca-Cola, Home Depot, PepsiCo, and Broadcom. Many investors love SCHD because it provides meaningful income while still offering growth potential. Now let's talk about VOO. VOO is Vanguard's S&P 500 ETF. Rather than focusing on dividends, VOO tracks the 500 largest publicly traded companies in the United States. This includes companies like Apple, Microsoft, Amazon, Meta, Nvidia, and many other market leaders. VOO is designed to capture the overall performance of the S&P 500, which has historically been one of the strongest wealth-building indexes in the world. Unlike SCHD, VOO doesn't prioritize dividend income. Its primary focus is growth. Now, here's where things get interesting. Because at first glance, many investors assume VOO automatically wins because it has delivered incredible returns over the last decade. But the reality isn't quite that simple. Let's compare income. As of 2026, SCHD's dividend yield is generally around 2 to 3 times higher than VOO's. That means if your goal is generating cash flow, SCHD immediately becomes attractive. For example, a $100,000 investment in SCHD could potentially generate several $1,000s more in annual dividend income than the same investment in VOO. That's a meaningful difference, especially for retirees, income-focused investors, or anyone building passive cash flow. But what about growth? Historically, VOO has often outperformed SCHD during strong bull markets, particularly when large technology companies are leading the market. And over the last decade, we've seen exactly that. The rise of companies like Apple, Microsoft, Nvidia, and Amazon has helped push the S&P 500 higher. Since VOO owns these companies at larger weights, it has benefited tremendously. SCHD owns some growth companies as well, but its focus on dividend-paying businesses often means it sacrifices a little upside in exchange for income and stability. Now let's talk about volatility. This is something many investors overlook, because investing isn't just about maximizing returns. It's also about managing emotions. VOO can experience larger swings during market corrections because it has heavier exposure to growth stocks. SCHD tends to hold up better during certain market environments because many dividend-paying companies are mature businesses with stable cash flows. This doesn't mean SCHD is risk-free. It simply means the ride may feel a little smoother at times. Now let's look at a simple example. Imagine two investors each have $100,000. Investor A buys SCHD. Investor B buys VOO. Over time, Investor A receives significantly more dividend income. Investor B may experience stronger growth during certain market cycles. Neither investor is necessarily wrong. They're simply prioritizing different goals. One is focused more on income. The other is focused more on growth. And that's really the key takeaway from this entire comparison. Many investors spend too much time asking which ETF is better, when the more important question is, better for what? If your primary goal is building passive income, SCHD may deserve serious consideration. If your primary goal is maximizing exposure to America's largest growth companies, VOO may be a better fit. And for many investors, the answer isn't choosing one over the other. It's owning both. Because SCHD and VOO actually complement each other quite well. VOO can provide growth. SCHD can provide income. Together, they create a portfolio that balances both objectives. So which ETF should you actually own in 2026? If you want higher income, SCHD has the advantage. If you want pure S&P 500 exposure, VOO has the advantage. And if you want a blend of growth and income, a combination of both may be worth considering. The good news is that there isn't a terrible choice here. Both ETFs are built around high-quality U.S. companies. Both have low expense ratios. And both have rewarded long-term investors historically. At the end of the day, success will likely come less from choosing between SCHD and VOO, and more from staying invested, remaining consistent, and allowing compounding to do its job over time. If you found this breakdown helpful, subscribe to Asset Index, where we simplify investing, ETFs, and long-term wealth building.